Welcome back to the Ultimate Trading Podcast for beginner traders. We're deep into our chapter on tools and technologies with Tip 63, Economic Calendars. These tools act as your early warning system in a world where central bank surprises or data shocks can wipe out positions in moments. I've lived through those moments myself. Early in my trading years, I held a sizable long position in euro to US dollar through a major US data release I hadn't marked. The number came in far stronger than expected, the dollar surged, and within minutes, my stop was hit, turning what should have been a manageable risk into one of my largest single trade losses. That experience burned into me the truth that no matter how refined your technical setup or how disciplined your risk rules, ignoring the economic calendar is trading with one hand tied behind your back. As Paul Tudor Jones once observed, the most dangerous words in trading are "this time it's different," and economic events are where markets remind us they're driven by real-world information flows, not just charts. Economic calendars aggregate scheduled releases of macroeconomic data, central bank announcements, speeches, and other events that historically move markets. They provide release times, adjusted to your time zone, consensus forecasts, previous figures, and often an impact rating, low, medium, or high, to signal potential volatility. In late 2025, with central banks navigating persistent inflation pressures, resilient labor markets, and shifting growth outlooks, these calendars are more vital than ever. Just look at the recent FOMC meeting on December 9th to 10th, where the Fed delivered a quarter-point cut but signaled a likely pause, with projections showing only one further reduction in 2026. That decision rippled through currency pairs, commodities, and equities, underscoring how data-dependent policymakers remain. The core value lies in four areas. First, understanding market movements, high-impact events like non-farm payrolls, CPI readings, GDP figures, or rate decisions inject massive liquidity and direction. A deviation from expectations, say, hotter inflation, can strengthen a currency as rate hike odds rise. Second, timing trades. Many traders reduce exposure or flatten positions ahead of red flag events to avoid whipsaws, or position for breakouts post-release. Third, risk management. Knowing volatility windows lets you tighten stops, reduce position sizes, perhaps to 0. 5% risk instead of 1%, or use options for protection. Fourth, strategy enhancement. Some approaches, like news straddles or fade the extreme reactions, rely directly on calendar timing. To use them effectively, start with reliable sources. Forex Factory remains a favorite for its clean interface, color-coded impact, red for high, and active forums discussing expectations. Investing.com offers comprehensive coverage with real-time revisions and volatility meters. TradingView integrates directly into charts for seamless overlay. Baby Pips provides beginner-friendly explanations, and FX Street, where trading economics deliver deep historical context. Master Key Indicators, non-farm payrolls, NFP, released the first Friday, or adjusted, like the upcoming December 2025 report delayed to Tuesday, December 16th due to prior data lags, measures U.S. job growth excluding agriculture. Strong readings bolster the dollar via growth and rate expectations. Consumer Price Index, CPI, tracks inflation, hotter prints pressure bonds and favor hawkish policy. Gross Domestic Product, GDP, gauges overall expansion, revisions can surprise. Interest rate decisions from the Fed, ECB, BOE, or BOJ shift entire yield curves. Unemployment rates, PMI surveys for manufacturing/services, retail sales, all feed into the narrative. To use them effectively, start with reliable sources. Forex Factory remains a favorite for its clean interface, color-coded impact, red for high, and active forums discussing expectations. Investing.com offers comprehensive coverage with real-time revisions and volatility meters. TradingView integrates directly into charts for seamless overlay. Baby Pips provides beginner-friendly explanations, and FX Street, where trading economics deliver deep historical context. Thus help you master key indicators. Non-farm payrolls, NFP, released the first Friday, or adjusted, like the upcoming December 2025 report delayed to Tuesday, December 16 due to prior data lags, measures U.S. job growth excluding agriculture. Strong readings bolster the dollar via growth and rate expectations. Consumer Price Index, CPI, tracks inflation, hotter prints pressure bonds and favor hawkish policy. Gross Domestic Product, GDP, gauges overall expansion, revisions can surprise. Interest rate decisions from the Fed, ECB, BOE, or BOJ shift entire yield curves. Unemployment rates, PMI surveys for manufacturing/services, retail sales, all feed into the narrative. Customize these apps ruthlessly. Filter by currency, USD for majors, impact level, or session. Set alerts via apps or platforms. Integrate into routine, review at week start for the big picture, daily for intraday threats, and pre-session for overlaps like London, New York, where liquidity amplifies reactions. Historical analysis is gold to study past releases. For NFP, average initial moves exceed 100 pips on majors. Deviations of 50k jobs often sustain trends. CPI surprises correlate with bond yield shifts impacting carry trades. Strategies vary. Conservative traders sit out high-impact news, re-entering on retraces. Aggressive ones straddle, pending orders both sides with OCO, that is, one cancels other, capping risk while capturing breakout volatility. Others fade extremes if technicals contradict fundamentals. Let me share a detailed personal story from earlier this year, building tension around the November 2025 NFP, which carried extra weight post-Fed signals. Markets were jittery, the dollar had weakened on cut expectations, euro to US dollar grinding toward 1.095 resistance amid ECB hold steady vibes. But labor data stayed resilient, prior ADP private payrolls beat, raising odds of hot NFP strengthening USD and delaying cuts. I flagged the release early via Forex Factory, high red impact, consensus 180k jobs, unemployment steady at 4.1%. Historical review, last 3 beats averaged 120 pip USD gains intraday on euro to US dollar. Technicals showed a bearish divergence, price higher highs but RSI failing to confirm. Near a multi-month trend line. Fundamentals aligned, strong jobs could force Fed hawkishness. Preparation spanned days. I reduced overall exposure, journaled contingency plans. My risk parameters, a max 0.6% account per leg for Straddle. Won the night before, the final checks, no revisions flagged, whispers of upside surprise on wage growth, another dollar booster. 10 minutes pre-8:30 ET, placed Straddle on euro to US dollar, buy stop at 1.097. Sell stop at 1.091, with stops 80 pips away and initial targets 160 pips, 1 to 2 risk reward. I used OCO, sized conservatively. The release hit, 220k jobs, wages 0.4% monthly beat, and the USD exploded. Sell triggered instantly, price cascading 180 pips in first 20 minutes as stops snowballed. Brief retrace tested nerves, unrealized drawdown 50 pips, but no reversal signals. Trailed stop using 20-period ATR, locking floats. Momentum resumed, hitting target near 1.07 for 250 pips net after partial scales over hours. Post-trade reflection, calendar awareness turned potential disaster, holding counter-trend, into controlled profit. Without it, FOMO or denial could have kept me long into the plunge. What are the common pitfalls? First, overtrading every event, focus on Tier 1. Second, ignoring revisions, they often drive secondary moves. Third, forgetting correlated assets. Strong NFP boosts equities initially but pressures gold. In thin December liquidity, moves amplify. Perfect for prepared traders. As we wrap this extended dive into economic calendars, remember, they're not about predicting outcomes perfectly but about respecting uncertainty and positioning accordingly. Discipline amplified by information is unbeatable. Which economic event has delivered your biggest lesson, win or loss, and how did the calendar play into it? Share in the comments below, your stories help us all grow. Disclosure: throughout this episode, I have mentioned various platforms, tools, books, and resources that I personally use or find valuable in my trading journey. I am not affiliated with any of them, nor do I receive any compensation, payment, or commission for mentioning or recommending them. These references are based solely on my own experience and are shared for educational purposes only. Thank you for your attention to this matter.
Thank you for listening to this chapter of the Ultimate Trading Guide for Beginner Traders, proudly brought to you by BellsForex AudioWorks. If this episode helped you even a little, please hit follow and leave a quick rating. It means the world and helps other traders find us. While the episode is still fresh, jump over to BellsForex.com/tools. 6 professional trading tools we just released, completely free, no sign-up. Thousands of traders are already using them daily. The full written guide is waiting for you at BellsForex.com, 100% free, or on Amazon Kindle and paperback. See you in the next chapter. Trade calm, trade smart, and keep building that edge. Happy trading.